In this example problem, we are going to do a deeper analysis of sales for a company called Roper Outfitters. At the beginning of every period, manufacturers make their best estimate on not just what quantity of units overall they're going to sell, but what quantity of each one of their different product lines is going to move. And they estimate their overall margin, their overall profitability, based upon overall quantity of sales and the mix that's going to lead them that they expect from those sales. Doing sales variance allows you to break down the difference between what you expected to happen in your budget and what actually happened into different levels. The first thing that we have here, and I'll scroll back up and finish this later, but let's introduce this, is sales volume variance. Basically, the amount of differing contribution margin that you got because this overall sales volume wasn't there. People weren't buying as many boots, jeans, and hats, etc. And you can break that down into two subcomponents. The sales quantity variance, which is essentially how much of sales there were overall for the entire market that led to the difference in your margin, and the sales mix variance. Did you sell the quantity of each particular product line that you thought you were going to? Because some are more profitable than others. Maybe you sold the wrong mix. Beyond that, we can look at the market, which is what customer demand was for the type of product, in this case outdoor clothing, that we thought was going to be there. Were there enough people willing to buy boots and jeans and hats that we thought there was going to be? So let's break down what happened to Roper Outfitters between what they expected in their 2000XX third quarter budget and what actually happened as the results. This company produces outdoor apparel that appeals to a rustic lifestyle. The company manufactures and sells 3 different products. Obviously, a real company would have way more than 3, but if you can do this for 3, you can do it for 300, so let's not make it too big. We are going to do a sales analysis to determine how the company can operate more profitably in the future, how we can change our budgets, etc. So the first thing we want is to figure out what our budgeted numbers were. Well, information on a per unit basis is provided here. For boots, we were going to sell them for $80 a piece. Each one was going to cost us $55 in variable manufacturing costs to produce, and we expected to sell 6,000. For jeans, the expected per pair of jeans selling price was $60 with a variable manufacturing cost of $40. We expected to move 8,000 of those. And for hats, we expected to sell each hat for $40. We expected each hat to cost us to incur $25 in variable manufacturing costs, and we were going to move 2,000 of that particular product during the period. So I can start by filling in my budget. The budgeted selling price for boots is given up above is 80. The budgeted selling price for jeans is provided up above was 60, and the budgeted selling price for hats was 40. The variable cost of boots was expected to be $55 per pair. The variable cost of jeans was expected to be $40 per pair. And the variable cost of hats was expected to be $25 per hat. Next thing we have is our contribution margin per unit. Well, what is contribution margin? It is just sales price less variable cost. So for boots, if each one was expected to sell for $80 a piece, and each one was expected to cost us $55 in variable manufacturing costs, that means that the sale of a pair of boots was expected to contribute $25 towards Roper Outfitters fixed costs, towards its overall margin with which they could pay fixed costs. For jeans, selling at $60 a piece with $40 of variable costs means each pair of jeans that we sold was expected to contribute $20 towards our margin. And for hats, selling at $40 a piece with a variable manufacturing cost of $25 per hat means that the overall margin for that particular product was, or the per unit margin, for that particular product was expected to be $15. For units sold, we have this information up on top. It was 6,000 boots, 8,000 jeans, and 2,000 hats. So I can go through and I can just fill handle that information into here. And what total amount of units did we expect to sell? Well, that's equal to the sum of these 3. We expected in total to sell 16,000 pieces of apparel. Sales mix is what percentage of our total units expected to be sold was going to be composed, of each of our 3 different product lines. So for boots, we thought 6,000 out of the 16,000 units that we sold were going to be boots. If we take 6,000 and divide it by 16,000, we come up with 37.5%. So we expected when we made our budget that 37.5% of all sales were going to be for boots. For jeans, we thought that 8,000 out of the 16,000 units that we sold in total during the period were going to be jeans, or jeans were going to compose half our sales. And then for hats, 2,000 out of the 16,000 units we sold were expected to be hats. So hats were going to make up 12.5% of our apparel sales during the period. And now we have our total margin. This is the per unit margin. Each pair of boots was expected to contribute $25 towards paying our fixed costs. Well, if we sold 6,000 of those, and each one was going to contribute $25, that means the sale of 6,000 pair of boots in total was going to contribute $150,000 towards covering Roper Outfitters' fixed costs. Jeans, our margin was $20 per unit. We expected to sell 8,000 pair of jeans, so 8,000 pair of jeans with each one contributing $20 towards our overall margin means that jean sales as a whole were going to contribute $160,000 to our overall margin to cover our fixed costs. And one more time, $15 per hat times 2,000 hats sold means that hat sales were expected to contribute $30,000 in total towards covering our fixed costs. And our total contribution margin across all 3 of these products was expected to be $340,000. Make this a little bit bigger. There we go. Well, what actually happened? It's the same steps that we did before, but now instead of using the 3 budgeted amounts that we have over here, we're going to use the 3 actual amounts. So the actual selling price of boots was $78 per pair on average. The actual selling price of jeans was $59 per pair on average. And the actual selling price of hats was $42 per pair on average. And my formatting's a little off, so let me go and fix that. There we go. The variable cost to produce a pair of boots was $56. The variable cost to produce a pair of jeans on average was $36, and the variable cost to produce a hat on average was $25. So what is our contribution margin per unit? Well, if we sold each pair of boots for $78 on average, and each one on average costs us $56 to produce, that means the sale of any one given pair of boots contributed $22 to our overall margin. For jeans, we sold each one on average for $59 per pair. Each one cost us on average $36 in variable cost to manufacture. That means that each pair of jeans that Roper Outfitters sold during the period contributed $23 towards the company's margin. And then for hats, at a selling price of $42, less the $25 in variable manufacturing costs it took to make each unit, means that each hat contributed $17 towards our overall margin. How many of these did we actually sell? Our information tells us that we sold 5,360 pairs of boots. We sold 6,432 pairs of jeans, and we sold 1,608 hats. So if I go and I fill handle, I can bring in all of those numbers. How many units did Roper Outfitters actually sell in total? We sold 13,400 units. So right then and there, before we go on any further, our total expected sales, or our total actual sales, was way below expectations. I got a feeling we are going to see some ugly, unfavorable variances coming up because we sold 2,600 less pieces of apparel than we expected. But we can't just say that. We got to break it down in terms of why. Is it because we did something wrong? Is there not a demand for rustic apparel? And furthermore, is the whole thing attributed purely to the quantity of goods that we sold? Or in addition, did we not sell the right mix of goods? Did we not sell as many of our most profitable units as we thought we were going to? Well, let's first figure out what our actual sales mix was. It is the number of units sold of each type divided by the total amount of apparel that we sold. 5,360 units that we sold out of the 13,400 in total were boots, which means boots made up 40% of our actual sales mix. 6,432 pairs of jeans were sold out of the 13,400 pieces of apparel that we sold during the period. So 48% of our actual sales came in the form of jeans. And 1,608 hats were sold out of the 13,400 pieces of apparel that we sold. That is 12% in total. What is our total contribution margin? Our total contribution margin for boots was $22 per unit times the 5,360 pairs of boots that we sold. Boots in total actually contributed $117,920 towards covering our fixed costs during the period. Each pair of jeans had a margin of $23. Well, if we sold 6,432 jeans, I multiply those two together and I find out that jeans contributed $147,936 to our fixed costs, to our margin during the period. And for hats, add a contribution margin per unit of $17 times the 1,608 hats we sold means that hat sales contributed $27,336 towards covering Roper Apparel's fixed costs. And in total, the company's overall actual contribution margin was $293,192. Sales by this particular outfitter accounting for only the variable costs of manufacturing, so direct materials, direct labor, any variable overhead we had. After we accounted for all of that, we had $293,192 left to cover our fixed costs, which was below our expectations. So let's go down and break down sales and figure out what happened here. For sales volume variance, it's always going to be the same formula. It is the difference between the actual quantity of units sold and the budgeted quantity of units sold multiplied by the expected or budgeted contribution margin per unit. So for boots, what was our actual quantity of boots sold? The actual amount of boots we sold, we have right here is 5,360. For jeans, we have that too, is 6,432 is the actual number of units sold, the actuals. And then 1,608 was for hats. So I'm going to go and I'm going to just handle that all in. Well, what did we expect? What was the budgeted amount? We expected that we were going to sell 6,000 boots, 8,000 jeans, and 2,000 hats. So I can go and I can bring in all of those numbers. And then our budgeted, our expected contribution margin per unit was expected to be $25 for boots, $20 for jeans, and $15 for hats. And there's all that information. I don't want these dollar signs, so we're going to kick them out too. So to figure out what my sales volume variance for the period was, it's going to be equal to actual quantity less budgeted quantity times our budgeted contribution margin. So here it's going to be equal to, open a parenthesis, the 5,360 boots we actually sold less the 6,000 that we expected to sell times our budgeted contribution margin of $25 per boot. If we sold, the difference between these two numbers is 640. We sold 640 less pairs of boots than we thought we were going to. If each pair of boots did in fact have a $25 contribution margin, that means that that decrease in boot sales should have reduced the amount of sales that we did during the period by $16,000. Should have reduced our overall margin by $16,000. And I can do the same math going down, and since I want all these inputs to change, I can just handle without having to mess around. Next up, we determined that selling only 6,432 pairs of jeans against the 8,000 that we expected to sell means that at our expected rate of $20 per jean, our margin should have been $31,360 lower than expectations because we sold a ton less jeans. And then one more time, for hats, That is a difference right here of 392. We sold 392 less hats than we thought we were going to. If each hat did indeed contribute $15 towards our overall margin, selling 392 less hats should have lowered Roper Outfitters' overall contribution margin by $5,880. In total, $53,240 of our decrease in our overall margin is attributable to the fact that we just sold way less units than we thought we were going to. Well, let's go and break this down into two different components. The first is our sales quantity variance, which again is us looking at overall as a company. Is the problem with one of our product lines, or is it just with our company's sales in total? And we're going to start by taking the actual quantity of all units sold. This is all units sold. We actually sold 13,400. And since we're figuring this out for all of them, it's going to be exactly the same all the way down the line. We expected to sell 16,000 units in total. Means, again, we sold 2,600 less units than we thought we were going to. All things equal, if we hit our mix that we expected, if 37.5% of our sales of the 13,400 we actually sold ended up being boots, and if 50% of the units we actually sold ended up being jeans, and if 12.5% of the units we actually sold ended up being hats, what is that going to do to our overall variance? Because that's going to analyze, did our numbers come off because overall sales were down or because we sold the wrong mix of products? So I'm going to take the budgeted sales mix per unit. We have that up here, bringing it on down. 37.5%, 50%, and 12.5%. And then I'm going to take the budgeted contribution margin per unit that we started with. We said it was going to be $25 for boots, $20 for jeans, and $15 per hat. So let's bring that guy on down. So to find my sales quantity variance, I'm going to use the same formula over and over and over again, which is I'm going to take the difference between actual quantity and budgeted quantity, and I'm going to multiply that difference by the budgeted mix, and one more time I'm going to multiply that by the budgeted contribution margin. So here our actual quantity of sales was 13,400 overall. The budgeted quantity we expected was 16,000, so we sold 2,600 less units. Well, 37.5% of that 2,600 piece of apparel decrease we had, if our mix was correct, should have been in the form of boots. So our sales should have decreased by that proportionate amount, and since that particular product was expected to contribute $25 towards our company's overall margin, that means that boots, had they actually ended up being 37.5% of our sales, and our sales dropped by the amount that they actually did, boot sales, the amount that should have decreased our contribution margin was $24,375, and I can use that same formula. If half of the 2,600 unit decrease that we had was in the form of jeans, and each pair of jeans had the $20 contribution margin that we expected, then our overall contribution margin should have decreased by $26,000 because of the decrease in jean sales. And then one more time down here, if 12.5% of all of our sales was in the form of hats and sales decreased by 2,600, well, 12.5% of that 2,600 times the $15 per unit margin that we expected hats to have means that the decrease in hat sales, if we hit our mix properly and we hit our contribution margin that we expected, should have decreased our overall margin by $4,875. $55,250 of our decrease in contribution margin can be attributed to the fact that we sold way less units actually than we thought we were going to. But let's figure out if there's any portion of this that can be attributed to our mix. I mean, we see that some units are better for our margin than others. Did we sell the proper mix? Well, we're going to start same way we started last one. Actual quantity of all units sold. We actually sold 13,400 units. What percentage of our mix did each one of our product lines actually consist of? Well, boots ended up actually being 40% of our overall mix. This is the actuals table. Jeans ended up being 48% of our actual mix, which was less than expected. And then hats ended up being 12% of our actual mix, which is also a little bit less than we expected. We thought it was going to be 12.5. Speaking of what we expected, our budgeted numbers are right here. We expected 37.5% of our sales to be in boots, so a bigger proportion of our overall sales came from boots than we thought. The other two products, a little slightly lower. We thought that jeans were going to be half our sales. They ended up being close, but not quite, 48%. And we thought that hats were going to be 12.5% of our sales. They came close, but not quite. They're only 12%. Well, our budget contribution margin per unit, we have this information here. We thought each pair of boots that we sold was going to contribute $25 towards our overall margin. We thought that each pair of jeans that we sold was going to contribute $20 to our overall margin. And then each pair of hats that we sold was supposed to contribute $15 to our overall margin. Well, now let's figure out our sales mix variance. And for this, we're going to take the actual quantity of all units sold. We're going to multiply it by the difference between actual mix and budgeted mix. And then we're going to multiply that by our budgeted contribution margin. So for these formulas, like two things are always going to be the same. We have actual quantity of all units, budgeted quantity of all units. Down here we have actual sales mix, budgeted sales mix. So basically what you're doing is you're finding the difference between the two inputs that are of the same nature, just actual versus budget, and then you're multiplying that difference by the other inputs. So here for our sales mix percentage, for our sales mix variance for boots, we take the 13,400 actual units that we sold. We multiply that by the difference between our actual sales percentage and our budgeted sales percentage, and then we multiply that one more time by the budgeted contribution margin per unit. And when we do that, because our boots were a bigger part of our mix than we thought, that increase in boot sales should have increased our overall contribution margin by $8,375. Down here, jeans were a little less of our mix than we thought we were going to, which means that that slight decrease in jeans out of the proportion of goods that we sold should have decreased our contribution margin overall by $5,360. And hats was just a little bit below what we had budgeted for, so that slight decrease in hats from our mix means that hat sales should have contributed $1,005 less towards our overall margin. But in total, we actually have a favorable sales mix variance. It's positive. Why is it favorable? Well, up here, we expected, actually I got right here, boots to be our most profitable unit, and a greater portion of our mix came from that most profitable unit. If I go and I add together our sales quantity variance and our sales mix variance, I come up with negative 53,240, which should look familiar because it's that number right there. We broke down the portion that our contribution margin was off because our sales volume wasn't what we expected into, all right, what portion of that's attributable to overall sales and what portion of that's attributable to selling the wrong units, to a bad mix. And we see we actually had a good mix. So our real issue here is we just did not move as many units as we thought we were going to.